The financial engineering. This is a fairly new branch of finance. They they are they develop models based on computational finance and computer simulations and calculate the various risks. They minimize the risk, make decisions on the trading and stock investments. They're math heavy, they're tech heavy, but the payoff is heavy as well. They're paid lucrative salaries. I'll talk more about them when I talk about the jobs of quants, which are short for quantitative analysts. And very few universities around the world offer these programs. In Canada, there's only one, University of Toronto, which takes only 30 students every year. It's only one batch. The cost is around $40,000 for that program. So they also have value in the research field. They develop models to evaluate the risk of projects. So these big firms, when they have big stakes, like when they start a project, they invest a lot of money. So they have to assess the risk of that project and also all the financial aspects of that project. So these people do that. Why? Well, some people argue that mathematics is not a good way to judge the risk or remove the uncertainty involved in the finance field. But you can argue in the same way that even though you cannot reach a decision, you can reach a bit closer. Math is something which, seen properly, shows not only the truth, but supreme beauty. That's what I feel. So math is something that helps you. You can use it as a tool to minimize the risk involved. So jobs in finance. Finance is everywhere, right? So you can be in a non-financial firm or in a financial firm. If you're in a non-financial firm, there are many people who are, especially in the beginning, they're unable to differentiate between where to draw a line between accounting and finance. It's easy to draw, it's easy to judge by looking at the two job positions, which I'll be discussing right now. In any non-financial firm, the top finance position is CFO, Chief Financial Officer. And there are two people reporting directly to them. There's the controller and the treasurer. Controller is the job which is totally accounting based. He reports, he prepares the financial statements, reports, files them, takes care of the internal controls, also takes care of the management information systems. On the other hand, treasurer is the person who manages the cash. He ensures that the cash is available for each and every project in hand for the firm. So also minimizes the risk, also ensures that the cash flow is optimal for the firm. Moving on to the investment banking. This field has, in general, three broad criteria in which they hire the finance guys: sales, trading, and the pure finance. The first three positions you see up there are the pure finance positions, the corporate finance specialists. What they do is they deal with the corporate clients and help them raise capital from the capital markets. They assess the willingness of the capital market to provide the capital and also assess the need. And by assessing that, they come up with their solution and how the firm should raise money. Merger and acquisition specialists, they look for the mergers and acquisitions for their clients. Structured finance specialists, they come up with the derivative options in how to redistribute the cash the firm has. Investment advisors, these are most of the sales guys. So they monitor stock and industry trends that are likely to affect the client's investments. And they try to meet the required return of the client. They deal with the client on a daily basis, over the phone, or face-to-face. They advise clients on the products and services. They also arrange for the purchase of purchase or sale of stocks, bonds, or any other securities the client possesses. And when they arrange it, this is where the trading people come in. They are the people who need the most people skills because they have a responsibility to build and retain the client base. And this is the normal ladder in the investment banking field. In the first year when you just enter, you just need a bachelor's degree, and you enter as a first year analyst. And the minimum salary you get is about 60,000. And this is after the consideration of the huge executive reduction in executive compensation. So all these figures are after, like, even this one, the department head, which is the executive position again, is the reduction is after the consideration of that effect. And most of the big firms, financial firms, is already told that they're in the near future they will be increasing this compensation again, just in order to retain these retain the potential they have. So this is the ladder. The third year analyst, the first year associate, and in the end, it's the typical compensation is 2 million. This big range is due to the bonuses. It depends on how much money they make, like how much money they make for the firm. Hedge fund managers. These people manage a large amount of assets, and their earnings are totally based on the amount of return they're able to get from the assets they manage. So you can see their earnings are pretty high depending on how well they perform. It's just totally depending on that. The 2008 earnings of the top guy was $2.5 billion. So, and they're a bit different from the mutual funds just because they get involved in more short-term transactions than the mutual fund guys. The quants, which I told you, are the people who do the financial engineering programs. They design and implement mathematical models for pricing of derivatives, assessment of risk, and predicting of market movements. They involve in a lot of derivatives: forex, equities, fixed income, credit derivatives, commodities, hybrids, which are the mixture of equity and debt securities. So convertible bonds come into that category. So they are the people who prepare these models, computer simulations, to manage, minimize the risk in all the portfolios they manage, and also, as I told you about the projects these firms are planning to work on. And the recent job postings, I just took it from a website. They were posted within the last 10 days. And you can see that this position, these are all like financial engineering quants position. And this, they were offering 1 to 2 million plus benefits. So that's why I was saying that this is a very lucrative field. So, I'm George Lewis. Why I'm telling you about this example is because this is the person who is literally followed, like not followed, but this is the person we can look up to. He's done what I've been talking about like last 15 minutes. He started out with a bachelor's from the Trinity College, University of Toronto. He ended up doing CA. He was in Arthur Andersen, which is no longer a company after the Enron fiasco, but they were among the big five. That later on he went ahead and did his CFA, and he eventually got an MBA, but at a later stage, which he might have also got an executive MBA, for which usually the firm you're working on they pay. So it is a much comprehensive one-year program because the experience they have, you can take it in a later stage of career. And this guy is managing more than $63 billion today. And this position, group head of wealth management and portfolio manager, or similar positions in any financial firm, they have potential to earn more than the CEOs. In fact, they do earn more than CEOs sometimes, which are the top people of the firm. Why? Just because of the bonuses and the commissions they get due to the returns they make. So before I transfer it to Wade, do you have any questions regarding any of the stuff I talked about? Okay, thank you.